Nanox stock is the topic of today's presentation. This is a company that was formerly known as nano-x imaging. And if you're somebody that's invested in nano-x stock, then you're going to want to watch this because it covers a lot of issues with the company. So the last time we looked at Nanox was about 3 years ago. You can see several pieces that we wrote here, which did a pretty good job of defining the bull thesis here. And the conclusion that we reached back then is that we were going to wait until regulatory approval happens and revenues start trickling in before taking another look. Well, 3 years later, and both of these conditions have been met. So the brief on the bull thesis is that Nanox wants to democratize access to X-ray machines with their lightweight and mobile digital X-ray system using the powers of nanotechnology, thus the name. And this was taken from our last piece 3 years ago. They said, we introduced a working prototype of Nanox Arc in February of 2020. We plan to deploy the first machine in the first half of 2021. And they had the goal of finalizing deployment of the initial 15,000 Nanox systems by next year. Well, that date has now slipped by 3 years since they just received FDA approval this past April. Now, note the use of the word deployed. So most recently they talk about, this was in their document they produced for an institutional investor who's going to bring them another $30 million. They said, we have deployed our Nanox system units for training and demonstration purposes, initially in Nigeria, Ghana, and Morocco. So these are red flags. Whenever you see a medical device company or any sort of company that's involved in therapeutics or something relating to life sciences operating in these shady jurisdictions, then that's a red flag. We want to see revenues, not deployment. So all our focus is going to be on revenues. And when you look at, this was taken from a filing document from the company a while ago, and now they've replaced this with verbiage that talks about 12 relationships they have, which will generate somewhere around $180 million of product sales. This is a big nothing sandwich. So you can see here these MSaaS agreements they reached back in 2020 with these no-name companies. I mean, I don't recognize a single name here. And what are they doing in Belarus and Brazil and South Africa? There's enough opportunity for such a machine where they don't have to have such a broad reach. So this is attempting to show investors the opportunity, but as you can see, nothing's transpired of this. They've not realized any revenues from their machine. And of course, the response there as well, it just was approved. All right, well, then we should expect to see revenues from this MSaaS agreement where they deploy their machines and then the clients start using them on a per-use basis, and they'll start collecting recurring revenues. Now, when we analyze any company, not just Nanox, we do so using the red flag approach. And here you can see on the left, this is an article we just published, and you should read that before this presentation because a lot of what's in that we're not going to cover in this video. So I'll put a link to that in the description of this video. And when we take this red flag approach, it's similar to what a hiring manager does. So when you're looking for the perfect candidate, it's impossible to compare them all, so you start by looking for red flags so that you can eliminate candidates that aren't going to be a good fit. In the same way, when you look at the hundreds, thousands of stocks out there, all with their own appealing story, you want to always start looking for red flags because the bull thesis is a given. Now, after about 5 minutes looking at their 20F, that's the foreign equivalent of a 10K filing, we had some concerns. So they made several acquisitions, and the resulting financials are a software business that loses money. So that's detailed in our article. We mentioned the deployment of machines into Ghana, Morocco, and Nigeria for training and demonstration purposes. That isn't a positive as far as we're concerned. They have some lawsuits and an SEC investigation that are concerning. We'll talk a little bit more about that. And the other thing to note here is that both Citron and Muddy Waters issued short reports. Now, the idea was that we were going to vet both of these short reports in this video, but You can go read them yourselves. So the Citron report, that's available upon request. And we took a glance at the Muddy Waters report, and they say things like, we're short an nano-x stock because we think it's a much bigger piece of garbage than Nikola will ever be. They interviewed some radiologists who are critical of the company's claims. As they say here, 4 of the radiologists, without any prompting, compared nano-x to Theranos. They challenge images provided by the company for demos. They challenge the management, partners, partnerships, product claims, product viability. For example, these photos here show remember we showed that table of the relationships they had with entities in various countries. This is what they're claiming the entity in South Africa looks like, this address that was provided. So you can read that for yourself. We're going to take it with a grain of salt because this firm is, of course, short. They have a financial incentive to spell out the worst bear case possible, and it just seems to be a lot of he said, she said stuff. We don't really need any more red flags than we've already found. So in looking at the 20F, some other things we noted, the Foxconn subsidiary that was supposed to manufacture units is now Dagesh. So they're going to, on a purchase order basis with no formal agreement, produce these units for Nanox. And they talk about lower cost production than existing medical imaging systems. It's hard to see how you're going to do that when you just switched manufacturers that quickly, and then you have no formal agreement with the one that you're currently utilizing. They say here, this statement, our internal control over financial reporting was not effective as of the end of last year. Well, that's a big problem. That you should be all over that. And oftentimes we've seen that used as a caveat, more or less, to say, well, if something was wrong, then we warned you that we didn't have sufficient internal controls. Big red flag. They say we haven't demonstrated the feasibility of our digital X-ray source technology for commercial applications. That's a given because they have not yet commercialized their system, and they haven't realized any revenues from it either. And they talk of this second version that may need FDA approval again. Is this a never-ending loop of FDA approval announcements? And it would seem so. When you look at this article from Fierce Biotech, this was this past May, talks about how they scored clearance for their cloud-connected X-ray bed after years of FDA review. But then look at the article below there, dated in April of 2021, that says, Nanox eyes late 2021 launch date for digital X-ray bed after nabbing FDA clearance. So this becomes a recurring theme. Every couple of years, there's some FDA approval that results in a share price increase in press releases and little else. And when you look at some of the verbiage in their 20F, for example, this statement here, following receipt of clearance from the FDA, which they have, and this statement here, and if authorized by similar regulatory agencies in other jurisdictions, as if there's some pending items that are outstanding, then they say, our goal is to finalize deployment of the initial 15,000 Nanox system units we keep hearing about within 3 years. Presumably that's the April FDA approval following receipt of FDA clearance. But of course, you see that caveat. They say here, we have started to ship several units. Well, it'd be nice to hear several hundred units, not just several units. If you're going to deploy 15,000 units in 3 years, that's 14 units a day. So they really need to get busy and doing more shipping than just several units over to Ghana or Nigeria. They talk about 12 MSAS agreements, again replacing that table with this sentence about agreements to deploy a total of 6,850 systems in 17 regions. Then they go saying, we have not generated any revenue to date from sales of the Nanox system. They haven't generated revenue, period, from this system. And the companies that they acquired, those have done them no favors. When you go through the 20F, you also find some interesting bits on legal woes. So they have accrued this $8 million of settlement expenses in connection with 2 pending class action lawsuits against the company. We'll assume that's done and dusted. But the other problem here that's concerning is this SEC investigation that's ongoing. They apparently received a subpoena from the SEC requesting they provide documents and other information relating to development cost of the company's Nanox Arc prototypes. That's pretty important and interesting that they've now switched the vendor that they're using for production. Another thing the SEC wants to see is the company's estimate for the cost of assembling the final nano-x.arc product at scale. Again, going back to the manufacturer and the fact that they switched to an Israeli manufacturer, the whole thing is dubious, and this isn't the sort of thing that you expect to see from a company that's ready to commercialize some great product they've been developing over the last decade, among other things that the SEC has required, these two notable bits that we pulled out. Two important rules we have here at Nanox. We don't invest in companies with a market cap below $1 billion. There's, of course, the exception is when a company is above $1 billion and we're holding it and it drops. But we don't invest pre-revenue. That's probably the most important rule that we have. And meaningful revenues, what we look for, are $10 million in a single year. And Nanox is just below that with their acquired offerings and with their flagship product. They're at nothing. So a $1 billion company would need annualized revenues of at least $50 million for a simple valuation ratio of 20. That's market cap divided by annualized revenues. That's a measure that we use to value companies that aren't showing a profit yet, disruptive tech growth companies. So what it comes down to is we wouldn't invest in a company with less than $50 million in annualized revenues. And when you look at what Nanox is, what they're valued at, everyone wants price targets, so here are some. Doesn't matter if your firm cures cancer, we're not paying a simple valuation ratio over 20. And we're going to explore that topic a bit more in a coming video. Nanox trades at a simple valuation ratio of 57. To put that into perspective, Snowflake, a high-growth SaaS firm that Luddite Buffett invested in, sits at around 20. When it dips below 20, we'll add some shares. For Nanox, an SVR of 20. So for them to have the same valuation as Snowflake, that would be around $3.55 a share. However, we believe this firm should not be trading at a premium, just based on the many red flags that we've uncovered. So more likely, it would trade at around our catalog average of a simple valuation ratio of 6.5. That would be about $1.15 a share. So that's more like the range of where we think the valuation might be more appropriately reflect the company's potential. And of course, another way to decrease this simple valuation ratio is by showing investors some revenue growth. It's time now. We'd like to see some sales from this machine that we've been waiting a decade for to see sales from. We're not hurting for great companies to invest in right now at reasonable valuations. This isn't one of them. Pay very close attention when you look through that 20F at the language this company uses and hold them accountable to it. Establishing a cutting-edge medical product in emerging frontier markets, that's a big red flag, no matter how much they want to talk about democratizing access to medical imaging machines for poor people. This is a red flag. Constantly waiting for the next FDA approval creates this cycle of boom-bust that works well for promoters but not for investors. This isn't a company we'd be interested in at any valuation and remains a firm avoid in our catalog. Now, I'm going to put up another video here that you might want to watch. Before I do that, please click the Nanox logo on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.